Welcome to our deep dive into the world of direct lending to SMEs, how private funds are unlocking a trillion-dollar market. This video is for anyone interested in finance, small business growth, or investment opportunities, offering a comprehensive look at a rapidly evolving sector. Today, we're exploring how private funds are transforming the landscape of small and medium-sized enterprise, or SME, financing. We'll uncover the immense potential of direct lending, a market poised for significant growth globally. SMEs are the engines of economic growth, driving innovation, creating jobs, and fostering local prosperity. However, despite their vital role, they consistently face a significant obstacle: access to adequate funding. This funding gap has opened up a trillion-dollar opportunity for direct lending. Countries like India are emerging as key growth markets, where private capital is increasingly stepping in to meet the unmet demand. Traditionally, banks have been the primary source of SME financing. However, regulatory changes, risk aversion, and a shift in focus have led to banks retreating from certain SME segments. This retreat has created a void that alternative capital providers are eager to fill, bringing with them innovative financing models. Let's begin by thoroughly examining the core issue: the SME financing gap. Understanding its scale and underlying causes is crucial to appreciating the rise of direct lending. Globally, the SME financing gap is estimated to be over $5 trillion. In India alone, this gap stands at a staggering $250 billion to $300 billion, a massive untapped market for lenders and investors. Why does this gap exist? SMEs often lack the collateral, extensive track records, or formal credit history that traditional banks require. This makes them appear riskier to conventional lenders, leading to their exclusion from mainstream banking channels. The result is a classic demand-supply mismatch. Capital is available in the broader financial system, but it's not accessible to the very businesses that need it most. This creates a significant bottleneck for economic growth. The scale of this gap has become increasingly apparent, particularly as traditional banks have shifted their focus towards larger corporate clients or less risky lending avenues. This retreat has amplified the need for alternative solutions. The reasons for the traditional bank lending gap are multifaceted. They include stringent regulatory requirements, higher operational costs for small ticket sizes, and a general lack of understanding or specialized frameworks for assessing SME creditworthiness. Now, let's turn our attention to the innovative players stepping in to fill this critical void: the alternative lenders. This new ecosystem includes private credit funds, non-banking financial companies, or NBFCs, and innovative fintech companies. In India, NBFCs account for approximately 25% of SME lending, often focusing on segments underserved by banks. Fintechs, on the other hand, leverage technology and data for faster, more efficient underwriting and disbursement processes. These alternative lenders offer distinct advantages over traditional banks. They provide greater flexibility in loan structuring, allowing for tailored solutions that meet the specific needs of SMEs. Their approval processes are often significantly faster, and they require less documentation, reducing the bureaucratic burden. Crucially, they often focus on the growth potential of an SME rather than just historical financials. Private funds bring substantial capital and often a deeper understanding of specific industry niches. NBFCs offer a blend of traditional lending and specialized services, while fintechs are disrupting the market with their speed and data-driven insights. The flexibility allows for customized repayment schedules, security arrangements, and loan covenants. The speed means businesses can seize opportunities without lengthy delays, a critical factor in today's fast-paced market. The direct lending market is characterized by a range of innovative strategies designed to cater to diverse SME needs. Let's explore some of the key models. Direct lending involves private funds directly providing loans to SMEs, bypassing traditional intermediaries. Revenue-based financing ties repayments to a business's revenue, offering flexibility during fluctuating sales. Supply chain finance optimizes working capital by leveraging relationships within a supply chain. Venture debt is a specialized form of debt financing provided to venture-backed companies. It's often used by startups to extend their runway between equity rounds or to fund specific growth initiatives without diluting equity. Technology is not just an enabler, it's a fundamental driver of the direct lending revolution. AI-driven credit scoring models analyze vast amounts of data, including non-traditional sources, to assess creditworthiness more accurately and efficiently than traditional methods. Digital platforms streamline the entire loan application and management process, from onboarding to disbursement. Automation is minimizing manual tasks, reducing processing times, and enhancing accuracy. This includes automated document verification, smart contract execution, and real-time portfolio monitoring, leading to a more seamless and scalable lending operation. From an investor's perspective, direct lending to SMEs offers compelling benefits: higher yields compared to traditional fixed income investments, diversification away from volatile public markets, and the opportunity for impact investing by supporting economic growth and job creation. Governments also play a crucial role. In India, schemes like the Credit Guarantee Fund Trust for Micro and Small Enterprises, CGTMSE, provide comfort to lenders. Furthermore, public-private partnerships are emerging, blending government incentives with private capital to catalyze SME growth. While the outlook is promising, it's essential to acknowledge the challenges and consider the future trajectory of this dynamic market. For borrowers, higher interest rates compared to traditional bank loans can be a challenge. For lenders, the market is becoming increasingly competitive, requiring sophisticated underwriting and efficient operations to maintain profitability. The future of direct lending to SMEs points to continued growth, with private capital playing an even more central role. We anticipate a blurring of lines between different types of lenders, more sophisticated data analytics, and an increasingly dynamic market offering diverse financing options tailored to every stage of an SME's lifecycle. In summary, direct lending to SMEs is a powerful force unlocking a trillion-dollar market, driven by the financing gap, innovative alternative lenders, and transformative technology. This video is for educational purposes only and does not constitute financial advice. Always consult with a qualified financial professional before making any investment decisions. Thank you for watching.